The United States has never defaulted on its debt. That's what they tell you. That's what every economics textbook claims. That's what politicians repeat whenever the debt ceiling debate resurfaces. And technically, they're correct. America has never missed a bond payment, never failed to deliver promised dollars to Treasury holders. But here's what nobody explains. There's more than one way to default. You can refuse to pay. That's explicit default. Everyone sees it. Headlines scream, markets crash, or you can pay in full with dollars that buy less than what was promised. That's silent default. Nobody announces it, no headlines, no official recognition. And according to Federal Reserve data, it's happening right now. It's been happening for years. While you were watching the debt ceiling theater, celebrating when politicians reached another last-minute deal, something far more significant was occurring beneath the surface. The real value of your savings was being systematically transferred. From you, from every Treasury holder, from every American with a bank account, to the United States government. Not through taxes, not through legislation, through a mechanism so subtle that most people don't even realize it is happening until they notice their money buys less each year. When inflation exceeds Treasury yields, bondholders receive negative real returns. They get their dollars back. But those dollars purchase less than when they lent them. That's not debt repayment. That's debt erasure at the lender's expense. And according to the latest data, real yields on Treasury bonds have been negative for significant periods over the past several years. The silent default isn't coming. It's already here. Now, let me be absolutely clear about sources before we continue. I'm drawing from Federal Reserve interest rate data, Bureau of Labor Statistics inflation reports, Treasury Department debt figures, and academic research on financial repression published by the National Bureau of Economic Research. These aren't fringe sources. These are the official institutions that track American monetary policy. The concept of silent default, or default by inflation, is not conspiracy theory. It's documented economic mechanism, studied extensively by economists, including Carmen Reinhart, whose research on sovereign debt is considered definitive. What I'm presenting is the synthesis of official data that tells a story the financial media rarely explains in plain terms. When you see the complete picture, you'll understand why this mechanism remains invisible to most Americans. By the end of this video, you'll understand exactly how silent default works, why governments prefer it to explicit default, and what historical precedent tells us about the consequences. Because here's what most people don't realize. Silent default isn't new. It is not unusual. It's the standard method that heavily indebted governments have used to escape debt throughout history. There's a documented pattern here, a pattern that's played out dozens of times across multiple centuries. Same mechanism, same beneficiaries, same losers. And the United States isn't experiencing this for the first time. America has used financial repression before, with devastating consequences for savers who didn't understand what was happening. The only question is whether you'll recognize the mechanism while there's still time to adapt, or whether you'll discover years from now that your savings lost purchasing power while you thought they were safely earning interest. Stay with me. The next 15 minutes will change how you understand government debt forever. To understand silent default, you need to understand the 3 ways governments can handle unsustainable debt. Not the 2 ways they discuss publicly, the 3 actual options that history documents. Option 1, explicit default. The government announces it cannot pay, bondholders receive less than promised, or nothing. Credit ratings collapse, markets panic. Future borrowing becomes expensive or impossible. This is dramatic. This is visible. This is what governments desperately avoid because the consequences are immediate and severe. Option 2, austerity and growth. The government cuts spending, raises taxes, and attempts to grow the economy faster than debt accumulates. Over time, debt becomes manageable relative to GDP. This is painful. This is slow. This requires political courage that modern democracies rarely sustain. Voters don't re-elect politicians who cut benefits and raise taxes. Option 3, silent default through inflation. The government creates inflation that exceeds interest rates on its debt. Bondholders receive their nominal payment, but the real purchasing power of that payment is reduced. This is invisible. This is gradual. This requires no political courage because most citizens don't understand the mechanism. The technical term is financial repression. The practical effect is wealth transfer from savers to debtors. The largest debtor in America, the federal government. Here's how the math works. If you buy a Treasury bond paying 4% interest and inflation runs at 6%, your real return is negative 2%. You technically earned interest, but your purchasing power declined. Now multiply that across the entire national debt. Every percentage point that inflation exceeds borrowing costs reduces the real debt burden by hundreds of billions of dollars. It's default, paid for by people who thought they were being conservative, who thought government bonds were safe. The bonds are safe. They'll pay nominal value. It's the dollars that aren't safe. Now let me prove this pattern is real. 3 historical examples. Same mechanism, same outcome. 1945 to 1980, the United States, the original financial repression. This example matters because it happened here in America, within living memory, and because the mechanism is identical to what's occurring now. Following World War II, American government debt reached 120% of GDP, higher than today's levels by some measures. The situation seemed impossible. How could America ever repay such enormous obligations? They didn't. Not in real terms, they defaulted silently over 35 years. Here's how. The Federal Reserve cooperated with the Treasury to keep interest rates artificially low. This was explicit policy, documented in Fed meeting minutes and Treasury Department correspondence. Simultaneously, inflation ran persistently above these suppressed interest rates. Not hyperinflation, not obvious crisis, just consistent grinding inflation that exceeded bond yields year after year. The result? Treasury bondholders received negative real returns for extended periods across 3 decades. Economists Carmen Reinhart and M. Belen Sprancia calculated that this financial repression liquidated debt equivalent to approximately 3-4% of GDP per year during peak periods. Over 35 years, the accumulated effect was enormous. Debt to GDP fell from 120% to approximately 30% by 1980. Not because America paid down debt, because inflation erased its real value. Who paid? Savers, bondholders, anyone holding fixed income assets. Who benefited? The government, homeowners with fixed mortgages, anyone who owed money. This wasn't conspiracy. This was documented policy. Academic papers analyzed it decades later. The mechanism is not disputed. What's disputed is whether Americans understood what was happening to them while it occurred. Most didn't. They saw their bank accounts grow nominally. They didn't calculate that purchasing power was declining. They were silently defaulted upon while believing they were saving responsibly. The pattern documented. In America, in the modern era, 1945 to 1970, the United Kingdom, imperial decline funded by savers. This example matters because Britain's situation mirrored America's, but with more extreme outcomes. And because the consequences for British citizens who failed to understand the mechanism were devastating. Britain emerged from World War II with debt exceeding 250% of GDP. Far worse than America. The empire was exhausted. The economy was shattered. Explicit default seemed possible. But Britain chose option 3, silent default through financial repression. The mechanism was identical. Interest rates held below inflation, bondholders receiving negative real returns, the real value of government debt eroding year by year. British inflation averaged approximately 4% annually through the 1950s, while government bond yields were held below 4%. The gap seems small, but compound small gaps over decades and the effect becomes massive. By 1970, British debt to GDP had fallen dramatically, not through austerity, not through growth alone, through the systematic erosion of bondholder purchasing power. But here's where the British example becomes a warning. British savers who held government bonds, who trusted the safety of gilt-edged securities, watched their real wealth decline by over 50% across this period. Conservative investors, following conventional wisdom about safe assets, were devastated. Meanwhile, those who held real assets, property, equities, commodities, saw those assets appreciate faster than inflation. The wealth gap widened, not through different work ethics or intelligence, through understanding which assets survive financial repression. The silent default wasn't announced. The newspapers didn't explain it. Most British citizens discovered the effect only when they tried to spend savings they thought would provide comfortable retirement. Those savings bought far less than they'd expected. Same mechanism, same beneficiaries, same losers, different country. The 1990s to present Japan's unending experiment. This example matters because it shows what happens when governments become addicted to financial repression, when silent default becomes permanent policy rather than temporary solution. Japan's government debt exceeds 260% of GDP, the highest in the developed world by far. By any historical standard, Japan should have defaulted decades ago. They haven't, not explicitly, because they've perfected silent default. The Bank of Japan has held interest rates at or near zero for over 2 decades, often below zero. Meanwhile, even Japan's mild inflation means bondholders receive negative real returns. But Japan's experiment reveals the cost of prolonged financial repression. Japanese savers have been punished for 25 years. Real returns on savings have been negative for an entire generation. Those who saved responsibly in bank accounts and government bonds watched purchasing power stagnate or decline while asset prices rose. The wealth inequality in Japan has grown dramatically. Those who owned property, stocks, or businesses saw wealth appreciate. Those who followed conventional saving advice fell behind. Japan didn't experience dramatic crisis, No hyperinflation, no explicit default, just decades of gradual wealth transfer from savers to debtors, from citizens to government. The silent default, extended indefinitely, becomes permanent confiscation of saver returns. 3 examples, 3 nations, same mechanism. The United States used it after World War II. Britain used it simultaneously. Japan has used it for a quarter century. And the evidence suggests America has returned to this playbook. Now, let me show you why the United States is experiencing silent default right now. The data is unambiguous. Following the COVID pandemic, official inflation reached 9.1% in June 2022, the highest in 40 years. Meanwhile, 10-year Treasury bonds were yielding approximately 3%. Do the math. 3% yield minus 9% inflation equals negative 6% real return. Treasury bondholders didn't lose money nominally. They received their interest payments. But the purchasing power of those payments declined by 6% in a single year. That's silent default. Massive silent default. The largest in decades. Now, inflation has moderated. The official rate fluctuates between 3% and 4%, but Treasury yields remain in a similar range for many maturities. Real returns hover near zero or remain negative when calculated against experienced inflation rather than official measures. Let me put this in concrete terms. The U.S. national debt is approximately $34 trillion. Every percentage point that inflation exceeds average borrowing costs represents approximately $340 billion in annual debt reduction through lost purchasing power. Over the past 3 years, cumulative inflation has exceeded cumulative Treasury returns for many bondholders by significant margins. The real value of Treasury debt has declined by trillions when measured in purchasing power. That's not debt repayment, that's debt erasure funded by bondholders who thought they were earning safe returns. But here's where it becomes structural. The United States now pays over $1 trillion annually in interest on the national debt. More than defense, more than Medicare, just interest. How do you reduce that burden? There are only 3 options. We discussed them earlier. Option 1, explicit default, would destroy American financial credibility. Not viable. Option 2, austerity and growth, would require political consensus that doesn't exist. Not happening. Option 3, silent default, allows debt reduction without acknowledgement. Politically painless. Every incentive points toward continued financial repression. Keep rates below inflation. Let purchasing power erosion reduce the real debt burden. Never announce what's happening. The Federal Reserve will speak about inflation targets and employment mandates. They won't mention that negative real returns transfer wealth from savers to the government. And here's the projection that concerns observers. Federal debt is growing at approximately 6 to 7% annually. Even if interest rates remain stable, the compounding effect is massive. Within a decade, debt could exceed $50 trillion. The only way to manage that burden without crisis is continued financial repression, continued silent default, continued wealth transfer from those who hold dollars and bonds to those who owe them. This isn't prediction. This is the incentive structure. This is what the math demands. Now, I know what some of you are thinking. Let me address the counter-arguments directly. But inflation is coming down. The crisis is over. Inflation moderating doesn't reverse the damage already done. If prices rose 20% cumulatively and then stabilize, you've permanently lost 20% of purchasing power. The silent default that already occurred isn't reversed by future price stability, and moderate inflation above low interest rates continues the mechanism. You don't need 9% inflation for silent default. You need inflation exceeding yields. That condition persists. But my savings account pays 5% now. I'm earning positive returns. Are you? After taxes, your 5% becomes approximately 4% depending on your bracket. If actual experienced inflation exceeds that, you're still losing. And consider, banks offer higher deposit rates now. For how long? When rates decline, your nominal return falls, but prices don't decline with them. The mechanism continues. But treasuries are still the safest asset. They're guaranteed by the government. The nominal payment is guaranteed. The purchasing power is not. You will receive your dollars. Those dollars will buy less. This is precisely how the British felt about gilt-edged securities in 1950, guaranteed by His Majesty's government. Guaranteed to lose purchasing power for decades. Safety and preservation of purchasing power are different concepts. Treasury bonds provide the first. They don't guarantee the second. But this is just normal inflation. Every economy has inflation. True. But inflation above interest rates is not normal. It's policy. It's financial repression. Throughout the 1980s and 1990s, Treasury yields exceeded inflation consistently. Savers received positive real returns. That period was abnormal in historical terms. Financial repression is the norm for heavily indebted governments. We've returned to norm. So what does this mean for you? Practically, specifically, Right now, I'm not a financial advisor. I can't tell you what to do with your money, but I can share what the data suggests and what historically informed observers have considered during periods of financial repression. First, understand what silent default means for different assets. Fixed income, bonds, savings accounts, CDs. These are the assets that suffer during financial repression. They pay fixed nominal returns while purchasing power erodes. Throughout history, these conservative instruments have been the primary victims. Real assets, property, commodities, equities, precious metals. These assets tend to maintain purchasing power during inflationary periods. They're not guaranteed to perform, but they're not guaranteed to lose purchasing power either. Second, recognize that conventional wisdom was designed for different conditions. The advice to hold bonds for safety emerged during periods of positive real returns. When bonds consistently beat inflation, they were indeed safe stores of value. That condition may not apply during financial repression. Historical patterns suggest that conventional wisdom about safe assets may need reconsideration during silent default periods. Third, calculate real returns, not nominal returns. Don't celebrate a 4% yield if inflation runs 5%. You're losing purchasing power. The number in your account grows while what it buys shrinks. Calculate after tax, after inflation returns on every asset. That's your real return. That's what matters for preserving purchasing power. Fourth, understand the timeline. The American financial repression. After World War II lasted 35 years, Britain's lasted decades. Japan's continues today. This is not necessarily a temporary condition. It may be the new normal for as long as debt levels remain elevated. Position accordingly for years, not months. Fifth, stay informed. Watch the spread between Treasury yields and inflation. Watch federal debt growth. Watch Fed policy statements for hints about rate direction. These indicators tell you whether financial repression continues or moderates. If this analysis provided value, subscribe to The Silent Economy and hit the notification bell. I release new research weekly, and the next video breaks down exactly which assets have historically preserved purchasing power during financial repression periods, the specific allocations that protected wealth, and the warning signs that indicated when repression was ending. Drop a comment below. Tell me how you're thinking about real versus nominal returns, whether you agree with this analysis. What I might be missing? I read every comment. This channel grows through engaged discussion with people who understand that real financial education happens outside mainstream coverage. Here's what I want you to remember. The United States has never explicitly defaulted on its debt. That statement is technically true, but technical truth can obscure practical reality. When bondholders receive dollars worth less than what they lent, the practical effect is identical to partial default. Only the mechanism differs. The silent default isn't announced. It isn't debated in Congress. It doesn't make headlines. It just transfers wealth quietly, year after year, from those who save to those who borrow. The pattern is historical. The mechanism is documented. The current conditions match the prerequisites. You don't have to believe silent default is occurring, but you should at least understand the concept. At least calculate your real returns. At least consider whether your savings are truly safe or merely guaranteed to return devalued dollars. The pattern doesn't care if you believe in it. It doesn't need your permission. It doesn't wait for consensus. It just compounds quietly like it always has. The information is here. The data is public. The choice is yours. Thanks for watching The Silent Economy. And remember, the people who preserve wealth during these periods aren't always the ones who start with the most. They're the ones who understood the difference between nominal and real, between official default and silent default, between what they're told and what's actually happening.